Chaikin Analytics is an incredibly powerful predictive model that helps you gauge the likely performance of a stock over a 3 to 6 month time horizon relative to the market. And over time, and it's been proven through both independent back testing, my own forward testing, and more extensive forward testing done by the Chaikin Analytics people, that you keep a portfolio concentrated on very bullish stocks, and over that short period of time, you will outperform the market, and sometimes dramatically so. In the back test, over a 10-year period, the first 10 years of this century, the Chaikin Analytics system, picking very bullish stocks, outperformed the S&P 500 by an annualized percent of 22%. So remarkable performance. We're going to try to do something really different. And again, we're going to put what I'm already comfortable with as just a wonderful predictor of future valuations of stocks, and we're going to put it to the test. I have bought a single call or put contract associated with stocks that have earnings coming out this week. Most of the earnings activity will be later this week or early next. So the rules I had for each underlying is, obviously you never trade a full portfolio of speculative earnings calls. And so we're just putting these all in one portfolio to make this easy to demonstrate, okay? The other thing is I bought single contracts. And remember, price is going to determine how much of the overall portfolio value is going to be dedicated to each one. So whereas a Capital One single call contract would cost me $345, Boeing is going to be a lot more expensive with the, well, actually, I didn't trade a Boeing option. That's a leftover stock trade. Let me just find something. I think Baxter is fairly high priced. Nope, that's about the same. Let's try, well, I'm just trying to look. If I had somebody here who knew, Philip Morris is kind of a higher price stock, isn't it? Yeah, it's about the same. We'll find one. So you can tell this is kind of unrehearsed. All these are trading roughly about the same. Here's one. Okay. Northern Trust Company, single call contract is trading for around $490. Oh, it's a put contract. Okay, $490. And this is trading for $345. This one's trading for $200. So you can see some of these options in terms of portfolio weight carry a lot more weight than others. So we're not gauging the performance of this collection of calls and put options in terms of overall portfolio and performance. That's really important. Whatever portfolio gain or loss is going to have nothing to do with the reality. What we want to do is let's look at our win rate. But let's look at our win rate instead of a theoretical back test where we very conveniently take the market price of the option into the close the day before the earnings announcement and then sell at the perfect price at the open, the next day after earnings. To gauge our performance on a stock-by-stock basis. Let's do it the old-fashioned way and be actual real traders. Fight the market maker, deal with bid-ask spreads, deal with the volatility crush, and all the other things that happen when you are trading options speculatively over a very short time frame. But the rules for the trades are very simple. So, and let's take a stock that whose earnings came out, I think, this afternoon. I'm not even sure how it did after hours. Obviously, the options were closed by the time the announcement was made. I know that their earnings call is at 7 o'clock in the morning. By the way, it's late on Monday, the 14th of October. So this will be our one earnings place for the trading day tomorrow. And I'm going to follow up with this one, all right? But the rules are pretty simple. If the stock is bullish or very bullish, and it had earnings this week, and the options, because I only trade options into earnings, and I'll explain why in a second. The bid-ask spread on the earnings has to be less than 10% apart. You can see here we have the bid is at 410, and the ask is 420, or at least the mark is at 420. But the spread is less than. Actually, that's not the bid-ask, and it doesn't look like I have it on this screen. I guess you'll have to trust me that I did not enter an option position unless the bid-ask spread was pennies wide for the most part. And in the worst case scenario, it was no more than 10% difference, all right? You can get crushed by the market maker on illiquid options. You can do really well on the option trade and then lose so much in the difference between what you bought the option for and what you end up selling for that it negates whatever move you made. So trading liquid options really important. So that's one big rule. Is earnings had to happen this week. We bought puts if the Power Gage rating was bearish or very bearish. We bought calls if the power gauge rating was bullish or very bullish. We traded a couple of strikes in the money at around the 70 delta. And I'll explain that in a second, but we chose a option delta strike that normalized all of these trades. So we're basically trading a couple of strikes in the money to the point where the stock or the option acts more like the underlying stock. So that for every dollar of price movement up or down, the underlying option moves, with about 70% correlation. That was essentially the rule. And we used delta to determine that. So bottom line is a little bit deeper in the money, a little bit more expensive, and all the same expiration month, which was November. All right. So those are the rules, and we'll kind of get into it when we look at the one stock. So, and then the other rule is I bought everything today. So all of the purchases have been made. You can see we made 120 bucks. I just blindly bought these things in the middle of the bid ask, the middle of the trading day today, knowing we'd be getting out of everything at the open, the first open after the earnings announcement. All right. So that kind of lays out the trading rules. If you've never traded options before and think what I've just talked about is gibberish, all you need to know is that we use options to avoid the biggest risk of trading around earnings. And that is when stocks report earnings, their shares tend to really move. Like, for example, Mark Chaikin, about 2 weeks ago, called a company called Copart. I think it's CPRT, if memory serves. It is. And his call was correct, by the way. And you'll see the day that he called the earnings. This is the 15-minute bars. Let's take you to the daily bars. Here it is. Look at that. So this stock was trading at roughly 34 bucks, 35 bucks. This, by the way, Mark Chaikin made his bearish pick of the week like right around here. And so get into it Monday. It's very bearish. Price action really looks like this stock is poised to move down in a big way. And sure enough, it was a big winner for him and his newsletter. It's scary how right he is. And that's why I'm putting this to the test. So 35 in, and remember, he was recommending, or at least suggesting, or coming up with the idea that we'd profit by going short on the stock. That and it ended up going 30 bucks, so a huge move. More than 10% move in the underlying price. Stop losses don't matter when you have huge gaps because your catalyst happens outside of market trading hours, right? And unless you're into after hours and you understand that that's a very liquid market in itself. Stop losses don't matter. So you might position size to only take an appropriate portfolio loss of half a point to a full percentage point, but that's not going to help you. There's no control over gaps because a stop loss order is nothing more than at a certain price, trigger a market order. That's really all a stop loss is. So you can get just hammered, which is why we trade options. They're risk defined. And you can never lose anything worse than the full price of the option contract you paid, which is always a lot cheaper than the underlying. So let's go through an example from beginning to end. Let's start with a company I've never heard of until today, Packaging Corporation of America. If you have, great. It's just not one that's been on my radar. And you can see we bought a $55 call option for $4.10. The stock is currently trading at 58.52. No, we didn't make a big gain because of that. We bought in the money on purpose to have this stock trade more like earnings. So why don't we start there, and I'll show you what I mean. So, and again, what's the underlying called? PKG. So we look at PKG, a couple of things. By the way, all of these trades were out to November. So we didn't, we kept our month consistent. We also tried to keep the decision process that went into our strikes consistent. It was a single contract. That's the other thing. We didn't trade any more than a single put or a single call contract per underlying. We told you we were in the money, and we used something called delta. It's a Greek. It's something that if you're an option trader, you know backwards and forwards. If you're not, delta can stand for a lot of things, but the most important thing that it stands for here is that we wanted to pick a delta that optimized the cost that we were incurring for buying the option and holding it for a very short period of time, and the correlation to the underlying stock. So a delta of 1 means that the stock would act 100% like the underlying. So if the underlying 50 at 58.52 went up a buck, the option trading at 47.50, deep in the money, that one would also go up $1 in correlation. So dollar, for every dollar move up or down, the option price at this particular strike price would move up or down $1, okay? But you're paying a lot for that option, right? This would cost you $10 per share. And remember, whenever you buy an option contract, you're actually buying control of 100 share. Every one contract comes control over 100 shares of stock, and you can't buy any less than that. So to buy a single contract of a 47.50 deep in the money call option on PKG, it would set you back 10 times 100, between 10 and 11 times 100. Let's call it 1050, just for argument's sake. That's, $1,050. That's what you would have to pay. Still a pretty good deal, because to buy 100 shares of PKG, you would have to plunk down close to $6,000, right? 100 shares times 58.52 is $5,852. So you would still be controlling the same amount of shares for only a fifth of the price. That's the beauty of options, okay? The other beauty of options is that if this thing gapped down to 25 and lost 50% of its value, you'd be out $2,500, right? $3,000 almost. Here, even here, which is way too expensive an option to ever buy into earnings, you would be out. The worst case scenario would be right about $500, right? If we lost half of our value, this option price collapsed to 500. That's the worst case scenario. Actually, the worst case scenario for you is 1,000, right? Because a big move like that would probably eviscerate the option price here. Okay, so but that's too expensive. We want to risk less, and so if the trade goes against us, we're only out a lot less than $1,000. So I like trading around the 70 cents on the dollar mark. This doesn't mean that the option is going to move 76 cents for every dollar up or down that PKG goes after the earnings catalyst. It just means the first dollar. And then the option price movement will change based on a whole bunch of other variables. That could take 2 hours just to go over. So suffice it to say, we're choosing around the 70 cents on a dollar delta, all right? And that's what the delta indicates here, is this stock will move 76 cents. This option will move 76 cents for every dollar move in the underlying. But remember here, if the underlying moves from 58.52 to 59.62, in terms of a percent gain, that's roughly what? 2%, not even 1.75%. But a 76-cent move when you're paying hopefully around $4.20 or $420, $76 return on $420, that's almost 10%. So you see the power of leverage when it comes to options. You are in fact paying only $400, about $420, to control 100 shares of stock, as opposed to paying $6,000 to control 100 shares of stock. And the best part of all is, if you are wrong, you're out. The worst case scenario is you're out the cost of this option, or $400, which in terms of the percent hit to the portfolio, $101,000, if we were to lose $400, it's well under 0.5%, well within my trading rules risk tolerance. So when you're trading speculatively, that's the beauty of options. Now, there's a lot of other ways to trade, but this is the way I trade. In the money, around the 70 cents on the dollar mark, but not so deep in the money that you're kind of overpaying for what is a very short-term event. And there's some option traders who would criticize the amount I'm spending on this, but I have such confidence in the power gauge that I do want a close to dollar for dollar return. Why? Well, let's take a look at PKG. And here I've got it up here. The first thing is, we're in a huge uptrend, right? We look at the power gauge, it's bullish. And what's making it bullish? Experts. They love this stock and believe that it's going to outperform. And when you dive into it, they are revising estimates upward, and the analyst opinions is very strong. So to the extent that Wall Street analysts are right, this stock is poised to move higher. The second thing would be financial metrics and earnings performance. Basically, the track record of the company is it's a little better than average. Financial metrics, a little below average, but let's look under the hood and see what the deal is. So the return on equity is fine. It looks like it might be a little overpriced right now. The price to sales ratio is not great. Not too much equity, and the price to book is a little overvalued. So we are a bit priced per perfection. Of course, I didn't really look under the hood too much. We just bought this stuff blindly. But we do have a nice uptrend. We have a lot of institutional accumulation for months in the Chaikin money flow indicator. A little bit of a consolidation resulting in some very short-term underperformance relative to the market, but a healthy consolidation that's still above the upward trending Chaikin trend line, which is a 200-day double smooth moving average. You can see we had a pullback, and it looks like a nice bounce up here. We are also oversold, right? We love to acquire stuff when the oscillator is down here in this below 30 oversold zone, with the power gauge trending from yellow to green, which means we're getting bullisher. So those are the reasons. That's the Chaikin Power Gage at work. And so the prediction here is that we should do pretty decently tomorrow. Now, I may be covering something where the earnings have already come out. So I promise you I don't know what they are, but we're going to trade this. We're going to close this position within the first 15 minutes of the trading day tomorrow. Okay, and that brings me to the next thing. So we've talked about kind of why we bought this option. And the fundamental reason for playing the earnings to the upside tomorrow morning, and I think this is the only one of our basket that will happen, is the other rule is we bought everything today, we will sell within 15 minutes. We're not going to hold this any longer than through the trading day tomorrow. Now, I have a full-time job, and sometimes I have conference calls, and they get in the way of my trading. So this is one of the reasons I love this particular trading application. It's the Thinkorswim platform. It gives you a lot, as a working stiff, kind of a lot of options to trade here. So one of the things we're going to do is we're going to trade a closing order. We're going to do it at the market, okay? And that's another reason that, when we're not around, if you got to get out of something, the market maker's still making a 20%, or 10% profit on the bid-ask spread. So that's one of the I'm hoping I'm around tomorrow, but just in case I'm not, I don't want to hold this trade. So I'm going to give the market maker back a little bit of the bid-ask spread here. You guarantee he's going to fill me in the worst possible position. So we have to be mindful of that you can lose even when you win because of bad fills. All right. So you have to try to be around to get out of option trades. But hey, sometimes your boss calls you in for a conference call. So I'm going to sell one share tomorrow at the market. I'm going to submit the order tomorrow, 10:15, at let's call it 8:35, which is I'm in Central Time Zone, so the market for me opens at 8:30. So I want out of this thing at 8:35.00. Let the market churn a little bit. Let things settle. People make retail investors typically love to buy on the news, and then institutional traders like to stick it to them after the news comes out. So hopefully at 8:35 we'll be on the winning side of that, and we just want to get out of everything at 8:35 tomorrow, and we'll put that on, and then we will send. So that's our plan for tomorrow. Okay, and then I'll be back with other videos, and hopefully a little bit less long-winded, and we'll start covering stuff when the action gets really heated. But I'm going to just leave this open because, obviously my hope is to brag to you that thanks to Chaikin Analytics, 60% of my trades were winners with at least a 10% gain, blah, blah, blah. And my losers, I may have had 40%, but I was able to get out at an insignificant loss. So we'll see what our win-loss ratio is. This was really done blindly based on the factors that I laid out earlier. And just while you're looking at the screen, you can go now if you want, because I'm going to repeat myself, but we bought a single contract, a put or a call, depending upon whether or not the power gauge rating was bullish or bearish. I don't know if I can even find a put here because it ranks this stuff. Okay, here's one. So for Ultratech, where the earnings come out on the 17th before the market, we are going to be getting out of this thing, but we're betting that its current price of around $415 for a 100 share single put contract, that the stock will go down and therefore the value of this will go up. This is a bought. I am long a contract which shorts the stock, essentially. We make money when the stock goes down, which means we bought it for a certain price, Stock goes down, we'll sell it for a higher price. And so we got some puts on here, and that means that Ultratech was bearish. Again, if you want to go, I understand. Let's just check UTEK, because I didn't look at the power gauge. I just used the Chaikin spreadsheet. And you can see we got a bearish stock. We have a downward trending orange line, right at the top of the orange line. It is oversold. There is some institutional accumulation coming into earnings. The power gauge, though, has moved nicely from green to yellow to red and yellow to mostly red here lately. So, the experts aren't that crazy about this stock. The technicals are weak, and the financial metrics aren't bad. So the stock has got some pretty good valuation metrics. It is trading at a 21 PE, although for that company it's not that bad. So we'll see. See how this works, right? It's bearish, and we're hoping that that one goes down. So here's my list again. And we'll keep track of our results in real time over the next few days.